first step I would see is writing the will. The second step then I would see is figuring out what the parents want to do with the farm. And the third step is to look at the tax implications of that. And then once you've that figured out, then you can go and sign the legal instruments.
Happy New Year to all our listeners. I hope you had a restful and enjoyable Christmas and are looking forward to a productive and successful year ahead. The journey to successful succession planning can be a long one, but often the hardest part is starting the conversation with your family about who will take over the farm. This discussion needs to happen sooner rather than later, as a smooth transition is much more likely when you begin early and involve the entire family. In this second episode in our series on farm succession, we rejoin James McDonnell, a financial specialist with Teagasc, to discuss the next phases in succession planning and explore the practical steps around the fair deal and taxes in this process. So James, as we were talking in the last episode, we chatted a little bit around a mediator, and you brought up an example around 3 individuals wanting to take over a farm. I'm just thinking that a mediator might be useful in that type of scenario. I suppose, where does somebody find a mediator in the first place? And is there mediators that are specifically or maybe better designed towards or better suited towards an agricultural situation, or a good mediator is a good mediator?
There is an organisation called the Mediators Institute of Ireland. So they've got a website, www.teagemii.ie. So you could go on there and you could find yourself a mediator in your local area. So they're all kind of trained to a similar level. I know in Teagasc, when we started out, first of all, doing farm transfer work, I think back in 2012, I first met a lady by the name of Claire O'Keefe from Mallow, and she works as a mediator, mostly with farmers. So Claire has kindly helped us out at her events over the last decade or so. So she is one, but Claire can be quite busy because she's well known around the country. So you can also go on to the Mediators Institute of Ireland. So the website again, www.teagemii.ie is where you can find a mediator. And there's lots of good mediators. I've met several over the last decade working in this area.
And at the end of the day, James, the mediator is really only there to ensure the conversation flows and ensure there's not conflict, or maybe to resolve conflict. They're not there, am I right in saying, they're not there to chip in terms of, oh no, you want to consider the tax implications there, oh no, you want to consider that. They're not really there to do that.
No, it's a completely unbiased role is what the mediator has. So it's about helping the farm family get to a solution. So the mediator, as part of their work, they might first of all maybe interview the parents, find out what their concerns are, what they're worried about, what they want to do. And then they may interview all of the children and find out, what are their concerns, what would they like to get. And then all of that, I suppose, that's background information for the mediator. And then the mediator will get them all into a room and they will keep communicating more or less until they reach a resolution.
And then talking about the other professions that might have to be brought into this as well. You talked about the Teagasc advisor potentially in there. Are there others that should be brought into that conversation to make sure that, in whatever decision is going to be made at the end, that they're all the considerations are taken into account?
Yeah, the way I think of farm succession and the best way that from working in this area that I see that people should go about it. The first step I would see is writing the will. The second step then I would see is figuring out what the parents want to do with the farm. Okay. And the third step is to look at the tax implications of that. And then once you've that figured out, then you can go and sign the legal instruments. So where you get help, well, there's a lot of people involved. The first place is I would start probably as your local advisor, and they can help you out when it comes to cap payments, EU schemes, moving herd numbers. Maybe you're thinking of a farm partnership, so looking at that. The children need education qualifications, so talk to an education officer. Sometimes with farm succession, there might be another element. Maybe there's a piece of land that's not best suited to tillage or not best suited to graze, and maybe forestry might be part of it. And sometimes parents keep that piece of ground put it into forestry, and they claim the premium as a way of topping up their pension. And that land might transfer later. Then there's the non-Teagasc professionals. So you're looking at a good accountant. Now, accountant's bread and butter work is income tax, but transferring a farm is capital taxes. So you need to talk to your accountant in relation to capital taxes. And if your accountant is not good on capital taxes, maybe they'll refer you to one who is. Um, Citizens information are a very useful service if you're worried about, the fair deal scheme and what entitlements you have as an older person, what your pension entitlements are. The Department of Social Protection can give you your work history in terms of what PRSI payments you've made in your work and career and what kind of a pension you're entitled to. You also need an auctioneer to value all of the property that you're going to transfer because a tax return will need to be done on it. And you need to take those valuations to your accountant to work out the tax figure. And then if the taxes are going to be very high based on the transfer you're going to do, well, then you need to ask your accountant, is there a different way? Should the assets go in slightly different directions? Is there another way of tweaking the plan to minimize the taxes? And if there is, well, then that should be considered and you go back and communicate with your family. And the final step might be talking to the solicitor. Now, the solicitor is involved at the start in helping you writing your will and maybe conferring benefits. You may also want some legal security. So maybe you're transferring the farm and the farmhouse to the new farmer, but you want right of residence with the dwelling house. So there might be legal securities as part of the transfer. So a solicitor can help you out there. So you might need to consider or consult with the solicitor during the process and before you go to the accountant. But the last thing you do is sign on the dotted line. So you have to make sure every I is dotted, every T crossed, and everybody is happy with the proposal. And then with Law Society rules, your children that are receiving the benefits, well, they have to hire their own solicitor and they will need to look over and get advice from their solicitor around the gifts that they're receiving. Is it a wise decision to receive the farm and what limits are on it? And, so they're the professionals. So to summarize, the advisor, the accountant, the solicitor, citizens information, Department of Social Protection, mediator, and an auctioneer.
So James, just going back on that, I mean, if I was a farmer listening to this and I had, let's just say I had 100 acres, and let's just say that round figures, that was kind of €1 million. They might be listening to you kind of thinking, there's a mediator to be paid for, there's an accountant to be paid for, there's a solicitor to be paid for. Mother of God, what's going to be left? This is a terrible lot of money I'm going to have to pay for. But what you might do is you might give us an idea for that, say, farm. If you could manage to buy it nowadays, 100 acres of land, it was €1 million. Let's just say that was transferred in 1970 to the person who's now going to transfer it on. What's the general taxation kind of amounts that are potentially talked about there?
If we take €1 million farm that was inherited nearly 50 years ago, Michael, and you now want to transfer it to your child, and your child is just under 35. There are 3 taxes: capital gains tax, capital acquisitions tax, and stamp duty. If all of the timing is done correctly, there should be no tax due.
Oh, okay.
But then it's about ages. So there are triggers. And the first trigger that people hit is, the young person. There's young trained farmer relief from stamp duty if the farm is transferred to the young person if they have their green cert before the age of 35. Okay. Once they pass the age of 35, then they're on the hook for stamp duty. And the stamp duty rate is 7.5%. So on your €1 million farm, 7.5% is 75,000. Yeah. Now, related parties can claim a relief called consanguinity relief, which at the current moment in time reduces the rate of stamp duty to 1%. So 1% of $1 million is 10,000. So anybody over 35 that's going receiving a farm from a live person, consanguinity relief is what they'll claim, and they'll pay the 10,000. Now, there's no stamp duty on debt. So if If it's delayed until a will situation, well, then there's no stamp duty. Okay. Now, the consanguinity relief is renewed in 3-year batches in the budget every third year. And currently, I think it runs out in December 28. So at the moment, related parties where the person is over 35, it's 1%. But there's a time limit on that. So it's down to what changes will be made in the budget in October 2028. So then there's capital acquisitions tax, which is the third tax. So the slang name for that would be gift tax. So if I receive a gift, I have to pay a tax on it. And the threshold from a parent to child is 400,000. But if I don't have a whole lot of non-agricultural assets, so if after I received a gift, 80% of my total assets are agricultural, I can claim agricultural relief. That allows me to reduce the value of the gift to me from a million down to 100,000. And 100,000 is under the 400,000 limit that we currently have that was announced in the budget on the 1st of October this year. So you have to keep an eye on the budget around the CAT limits as well. So that farm could potentially come across tax-free to the young person. And if the young person is over 35, then you're caught for 1% stamp duty.
And what about CGT then? You mentioned CGT?
So CGT, the parents can claim retirement relief against CGT. So once they own and farm the land for 10 years prior to transfer, you can claim that. Now, in some cases, people have leased out the farm. So if the farm is on a long-term lease, so 6 years or longer, and there's a number of those after being completed, you can still claim retirement relief provided that the leases do not exceed 25 years. So you could do 3 or 4 leases. 4 sixes is 24. So if you did 4 6-year leases, you would then need to transfer, because once you go over the 25-year limit, you have to go back and farm it for 10 years again.
Go back to that, James. You mentioned in the last episode, we talked a little bit around, you had this 92-year-old farmer you mentioned, and his son who wanted to gift it to his son, or wanted to give it to the son who was 60 years of age, or give or take. Let's just say a person didn't do much planning at all about the whole thing. How bad can it get in terms of taxes? Let's just say that 60-year-old had a big house, was already paid for, and he already owned a house that was worth, let's just say, €500,000, which is not, mightn't be unusual. What could be the worst case scenario in that there in terms of having to pay tax if that son was to receive it?
Okay, so if that son was to receive the farm, the €1,000,000 farm, we'll call it, and he had a house worth, say,
500,000.
500,000.
Yeah.
Okay. So he doesn't qualify for agricultural relief. And let's say he received the farm in a will. Okay. So there's no stamp duty there, and there's no capital gains tax. So he just has
No, go back
CA.
a second now. Sorry, we'll go back again because this man was alive. You were telling us this man, this 92-year-old, is
He's
alive.
alive, yeah.
Let's just say he's
Yeah.
alive now and see where that goes.
Okay. If he's alive, there's no CGT on the parent because the parent would have owned and farmed it
Okay.
prior to transfer. Now, let's say it's within the 25 years and the son was farming it, okay? And it was a
Okay.
lease. There's stamp duty, 1% between once the deed
Father
of
and son.
transfer, yeah, father and son. So 1% of a million is 10,000. Then we look at CAT. So the son doesn't qualify for agricultural relief because between the house he has, the non-agricultural assets, and the farm he is about to receive, the farm is not 80% of the total. So therefore, he does not get agricultural relief. So if the farm is valued at €1,000,000, he can receive 400,000 from his parents tax-free, but the farm is 1,000,000, so there's 600,000 left that's taxable.
Yep.
The tax rate is 33%. So 33% of 600,000 is 200,000. So
Give or
it's a
take.
fine
Yep.
tax bill.
Okay. So the difference between planning and not planning is 210,000 because you mentioned stamp duty as well.
Yeah,
210,000 between the two, which arguably there's 20 acres gone off the farm if they're trying to trying to get out.
yeah, there is.
If
Yeah,
that isn't paid somewhere along the way.
yeah.
Okay.
So it can be costly that way. And yeah, earlier on, something I meant to say, Michael, you mentioned, traveling around to meet all of the different professionals, it could be expensive. There is a grant available for people to get advice. It was announced by the Minister for Agriculture back in 2023. So if you were to travel around and go meet your solicitor and go meet your accountant and go talk to your advisor, and let's say they charge you €3,000 for their few hours advice. Now, it might only be 5 or 6 or 10 hours advice, but you can take your receipt, and if written on your receipt is farm succession advice, you can present that to the Department of Agriculture through their succession planning advice grant. So you submit a receipt to Dublin into that scheme, and they will send you back 50% of your money. So you can claim up to 1,500, provided you spend 3,000. So the receipts are very specific. It's a very simple scheme. You just send in your receipts before the end of the year, and you'll get your money back in the first quarter of the next year.
And James, is that open-ended or connected to anything else, or is it just standalone scheme all on its own?
It's a standalone scheme that was announced in, I think it was around the ploughing match time in 2023. And so I think somewhere between 80 and 100 people applied for it in the final quarter of 2023. So it has been open all through 2024. I'm not sure how many people have applied, but generational renewal is such a hot topic across the world. And this is just something that the Irish government have brought in to help people to go and get the advice because, professional fees are quite strong. So we want people to get involved. And, it's European and government policy to have farms changing hands because young people tend to be better educated, understand climate change a lot better, can drive agricultural output and economic growth for the country. So, this is the government's and the EU's way of, food security and climate change, to try and sort all that stuff with young educated people. So that's just their policy. And this is just one of the instruments that they have brought in. And it's the exact same rate as if people want to set up a registered farm partnership. There's a 50% grant for that as well. And the typical partnership costs about 3,000 to set up.
Go back a little bit because, James, I still have this 200,000 in my head, like many people, in terms of, holy moly, if I make a bags of this, there's on a 100-acre farm, there's a lot of tax to be paid. Go back a second and just run down through or summarize up the age-related triggers a family really should have in their heads in terms of the family succession. And I'm just going to start you off with the first one. It's never too early to tell somebody what's going to happen to their farm. You mentioned in the last episode an 8-year-old or 9-year-old, I can't remember what you said, knew exactly where the farm was going. So I'll start off with that one and let you continue on from there.
Okay, the next age trigger is around succession farm partnerships. So there is there's a partnership called Succession Farm Partnership, and if you go into it, your parents must transfer the land to you between year 3 and year 10 of the agreement, and there's an income tax credit is the carrot in that scheme. So if you want to avail of all of the benefits, you need to be in that before age 32. The next trigger is the Young Trained Farmer Stamp Duty Relief. So you need to receive the farm before age 35 to claim full stamp duty relief. And that relief is reviewed in the budget every couple of years. So that's up for renewal in the budget in October 2025. So it runs out at the end of next year, and hopefully it'll be rolled over for 3 years. So they're Irish tax instruments or incentives. Then if we look at the EU, so a young farmer in the EU context is somebody that's under 40. So in the CAP direct payments, so there's a top up for young farmers. I think it's called CISYF is the acronym. But it's a top up on 50 hectares, up to 50 hectares of land. And if you've got the full 50 hectares of a farm, it could be 30,000 of a top up over 5 years. So it's a nice bit. So with the EU payments, you need to be under 40. And with some schemes, you have to be within your first 5 years of farming. So going on the herd number to rent a bit of land and keep 5 or 6 cattle is not the way to go. You need to be ready to farm properly when you go at it. So you've got age 40 and you have to do stuff within 5 years. So if you're on a herd number of 5 years, some of the incentives are there's a time limit on them, even if you're underage.
And typically, James, just on that one, typically a lot of young farmers taking over want to develop the farm, and there's capital to be spent. TAMS grants are available there, and I know there's a higher rate for those grants. Is there an age limit on those?
So age 40 again. So the 60% grant aid is up to age 40. And I think it might even be very scheme specific, Michael, that if you have the application in before your 41st birthday, it might be okay. I know that was the case with one of the schemes. And then if there's female people that, daughters or wives that want to get involved in the farm, I think there's a women's grant,
So,
TAMS. Now, TAMS isn't my area of expertise, but I think there's an age 60 limit on that. So when you're looking at schemes, you need to be very specific. And that's where the advisor comes in handy, because they know all these age limits. Then if we look at taxes, there's retirement relief. That doesn't kick in until you're age 55. So that's retirement relief against capital gains tax. And then on the 1st of January next year, there's an age limit there. It's changing from 66 and going up to 70. So so the parent to child gift triggers retirement relief, but it's unlimited at the moment. But once you pass 66, it's limited to 10 million. Now that's changing on the 1st of January, that you have to be under 70. So they've pushed out the age a little bit. Then there's stock relief for young people. So you can claim 100% stock relief where you increase the amount of animals on the farm, but you must do that within 4 years of starting to farm. So you need to be ready to expand if that's what you want to do with the farm. And then there's the fair deal scheme, which we said we'd come back to at some stage, and we might be coming back to it again after this. But if you transfer your assets today, Michael, and you think that you might need nursing home care within 5 years, the farm is on the hook even though you don't have it anymore. So there's a 5-year look back there. So sometimes people, by delaying a farm transfer, they're leaving themselves more open for some of the farm going to the government to pay for the nursing home care.
okay, we might come back to that maybe in the next bit. Is there an age limit on that, James?
No, there's no age limit on the fair deal scheme. It's just that's about paying for the nursing home. And first of all, you have to pass a care requirement. So if you need the care, you go to the nursing home. So that's the first thing.
Look, James, I'm just listening to you trotted out 1, 2, 3, 4, 5, 6, 7, 8 different ages there. In fairness to you, that's very good. You had them all off the top of your head, and you're able to there's a lot of information there. Look, we're going to leave it there, I think, for this week, because there's more to come back to, and we're going to come back to the fair deal, and there's a few other bits and pieces that we need to cover, I think, and we'll come back to that in the next episode. So I suppose for everyone listening, stay tuned, and we'll be back next week with a little bit more.
Thanks, Michael.
Finally, if you enjoyed this podcast, please recommend it to a friend or colleague. And as always, don't forget to rate, review, and follow on Apple or Spotify or wherever you get your podcast from. For more information, visit teagasc.ie. I'm Michael Hennessy. Thanks for listening. I'll be back next week with more tillage news and advice.